We have had a lot of media exposure to the SpaceX IPO, and we've gotten a lot of questions over the last couple of weeks about how it impacts clients' portfolios. And so we thought it would be best to bring an expert on to help us talk through it. I'm Jim Kantowski, co-founder at Curio Wealth, and I am joined by our friend from Dimensional Fund Advisors, Althea Trevor. Althea is a senior investment director at Dimensional Fund Advisors, and her role is to support the effective communication of Dimensional's approach and strategies to clients. And she was previously based out of the London office. Althea, is that correct?
That's right. Yeah.
You're not from London? You just
I'm not. No, I started in our Austin, Texas office. I'm originally from California, but started out in Austin, Texas, moved over to London for a couple of years, and have been back in Texas since I guess over 5 years now, the end of 2019. So it's been a while.
Nice. Yeah, Austin's a cool place, very popular nowadays, and a lot of people move there and say they love it.
It really is. It really is. I originally moved here in 2014. I'm probably one of the older residents at this point for how much growth we've had over here. So
you probably are. So I don't want to waste your time. I really appreciate you joining us. Again, this SpaceX has been in the news quite a bit, and it's been a big topic. So what we thought we'd do is just revisit IPOs and how it impacts our clients' portfolios. So I just thought I'd start and ask, what is an IPO?
That's a great question. And we'll just break down the alphabet soup a little bit. IPO stands for initial public offering. And basically what it means is it's the first stock offering on a public basis that a company's making. So prior to this, a company might have, gotten investment from private investors, not something that's publicly listed on a stock exchange. This is the first time a company is actually selling shares to the public. So that's what it is. It's one of the ways that new companies can kind of open themselves up to public investment. It's probably the one that we've all heard of quite a lot. There are other types of ways that companies can open themselves up, other ways called special purpose acquisition vehicles, other types of acronyms. IPO is one of these big ways. And oftentimes there are a lot of headlines associated with this. There's a lot of excitement. We've all read about SpaceX in the news. It's kind of common that with a lot of these IPOs, there tends to be a lot of excitement and a lot of headlines going on and the build up to it and kind of that initial period. So it's natural that a lot of folks might have questions about what does this actually mean?
Yeah, and the excitement around it tends to create a little bit of FOMO. And so people want to get access to these things. And there seems to be this feeling that if you can get in on an IPO, that it's going to explode and it's going to do really well and you're going to be really, really rich from doing that. So I'm going to get your perspective on that in a little bit. But so with an IPO, just to summarize what you said, that's when it goes out to the public and essentially a lot more money comes in to fund the business, and that can be used to grow the business, continue to expand, and achieve its objectives.
That's exactly right. Yeah, 100%. It's a way to open themselves up to new investors, more investors than they would have had before when they were private, basically. And there's a lot of excitement because investors are getting their first chance to really have, broad access to invest in this company.
Yeah. So there are investors prior to an IPO?
That's right. So when we talk about, private equity is probably a term that people have heard before. But, a company that's starting their business would get investors, but it's not something that's listed through a stock exchange. It's not something that's open to all investors. And so that's really what we're talking about here is a company moving from maybe a more limited set of investors in their initial startup kind of period to something where it's more broad. Their stock is going to be listed on a major stock exchange. Anyone can basically buy it through their brokerage account.
Okay. So there's limited access for someone like the general public or the average investor to invest in a SpaceX prior to it being a public company. And so this is a way to gather those investors to some.
That's right.
Awesome. All right. So how would someone participate in an IPO?
Great. Well, the first way was one way that you hear about a bit, and I think this is where that question of FOMO comes in. A lot of investors hear about people who are able to participate in the IPO at the initial IPO price. And sometimes it's unclear who gets to do that and how. So we can explain the mechanics a little bit. A lot of times, these initial offerings are open mostly to institutional investors. However, retail investors or just individual investors is what we mean. They actually do have access on some of these larger IPOs. You've probably read stories about investors being able to request through their brokerage account shares at the IPO price, basically the predetermined price around before that stock starts trading. And a lot of investors are really interested. We mentioned the hype, the excitement that comes along with these, often an anticipation for really big increases, maybe in the share price once the stock starts trading. And so often the interest or the demand for these shares can really vastly outstrip the supply. What that means is that access is not going to be even for everyone, and everyone isn't going to get exactly what they want. You might want a lot of shares of this offering, but it might only be able for institutional investors. You've got to usually meet a lot of criteria. It's basically determined by brokerage firms who gets that initial access. Now,
So it's real.
after, yeah,
Oh,
go
I
ahead.
was just going to say it's really hard, essentially, for somebody with a small account or the average investor to actually get the initial shares or a
That's
portion of the
right.
initial
Yeah,
shares.
it's often something that's very limited. Even larger institutional investors might not get all the shares that they want. And that's simply because there's a lot more demand than there is supply. Often the initial offered shares are going to be quite small. When you see this, for example, with SpaceX, what we're talking about here, they're offering a very small number of shares given the large size of this company. So as you can imagine, there's a lot more interest in those shares than there actually is to find those shares.
I was SpaceX actually, from what I understand and what I've read, there's actually a larger amount going to the public than typical IPOs. Is that correct?
Yeah, that's right. That's right. In fact, in some cases with IPOs, I mean, again, these are going to vary a lot, but in some cases, historically, we've seen institutional investors only be kind of the ones that are eligible. And in fact, one reason why I think there's been so much news and kind of regular interest from everyone is the fact that there are individual investors able to go out and through their brokerage account request these shares. These brokerage firms did have requirements around who was able to make those requests. And again, just because you make the request doesn't mean you get that allocation. But yeah, there was a lot more interest and a lot more, I think, average kind of, individual ability to make those requests. But again, just because you get that request in doesn't necessarily mean that investors got those shares.
So I'm going to ask about that in a second, but I just want to go back and just revisit. You mentioned the initial price. How
Yeah.
is that determined?
So there's a couple different ways. In the case, companies basically can determine this. Oftentimes, the price is determined through the offering process. So there's a period of seeing what types of interest there is. So all those institutional investors that we talked about might make their requests for a certain number of shares at a certain price, and then the price is often kind of determined through that process. In the case of SpaceX, that price can also be predetermined, and there's a price that that offering is made, and then everyone gets to decide how many shares they want to request for that given price. So really, it can depend a little bit, and we've seen some kind of different examples. But before the stock begins trading, there's an initial price that stock is kind of offered to those initial IPO investors.
How is that right? Is that price right?
So I mean, it depends. I think that's a great question. I mean, dimensional price is so important when we think about how to evaluate companies, right? So that price, the way that it is set, the fact that it's kind of either set by the company or set by some kind of process along with bankers and everything. What we do see oftentimes with IPOs, I'm just going to go back to kind of what we've seen historically as the price rise on day one. I think that's one reason for that FOMO that you talked about, people feeling, is oftentimes what you see is an IPO called a pop, right? An initial price increase. So whether that initial offering price versus kind of what price you see when the stock begins trading, happens, that's something that is pretty common to see. Might tell you a little bit of something about what that price is in the offering, right? Now, I think that this lends itself well to talk about the other common ways that investors are adding this stock to their portfolio, because it's not just all about price that the stock begins trading at. It's also about where it goes from there. And of course, once the stock begins trading, once it makes its initial offering, it's going to start trading in the marketplace. Investors are going to buy and sell it just like any other stock. And there's going to be, movement in the price over time. And so I think that's another important consideration. A lot of ways that investors who aren't able to participate in that initial offering, or if they maybe didn't get these shares that they wanted, but they still want to buy that stock, they've got to go on the market and buy shares in that company after it starts trading. And so I
So
think
what?
that's the next, yeah.
Yeah. So I was going to say, like, why not do that? Like, what's the downside from doing that?
I think it's a great question. And I think we're gonna touch on a little bit of like talking a little bit about indexing and how indexers have thought about it, because I think that is something that you hear a lot of news stories about how different funds are adding that stock. There's definitely a lot once that stock is publicly traded. Now that access, that ability to buy and sell it on a stock exchange is there. So really anyone can go out and add it to their portfolio. You asked kind of why not, or why to be considerate about it. And I think this goes back to how Dimensional thinks about evaluating the purchase of really any company, any stock for our portfolio. First of all, we want to think about expected returns. So oftentimes when you see new IPOs launch, those stocks might be more expensive. We know there's a lot of research that tells us that stocks that are more expensive or on the growthier side versus value, they tend to underperform. So there's important information that we have about expected returns. We also know that mega cap companies tend to underperform smaller cap companies. Less profitable companies tend to underperform more profitable companies. So there's all sorts of characteristics that can tell us about a company in terms of its expected return. That's going to be really important when we think about why we might want to own a certain company versus another, or how much of it we might want to own. But there's another thing that's really particular to IPOs. And that's also that often those original investors in those IPOs, so those are pre-public traded companies. These might be private investors from before the company went public. There can often be lockup periods, which is a period of time that an investor is prohibited from selling their shares. As soon as a company goes public, there's a lot of headlines. You don't want every investor in your company to suddenly sell their shares. What happens when you've got a lot of sellers? Price will probably go down. That's some bad headlines for that new company, right? So generally, there's going to be some considerations on how long investors that were invested in that stock need to keep holding to those shares. We call those lockup periods. And so generally, there's going to be some period where lockup periods are expiring during that initial maybe 6 to 12 months of trading. And so that's one reason why you might see some limitations around, how certain investors in those companies can buy or sell their shares. And that might be why a lot of research shows that IPOs tend to underperform other companies during that first maybe 6 to 12 months of trading. So
Okay.
there's just important research specific to IPOs around how they perform after that initial maybe first day of trading, kind of how they perform for that first up to a year of trading on the market.
So that's really interesting to me. So what you're saying is that there's all these investors that potentially hold these shares that they can't sell them right away, and once their lockup period expires, most likely there's a good chance that, well, I'm not going to say most likely, but there's a good chance that those now go out onto the open market and the market is flooded in a way and the price goes down.
Yeah, I mean, it can be, right? It's just a potential headwind, right? Those
Yeah.
expiration of those lockup periods. If you think about the path for some of those investors, a private investor, they're going to have kind of an inability to sell their position, right? Maybe they got in at the ground floor of this investment. The stock went up a lot, right? You don't see, companies that are failures going out and making public offerings, right? So obviously this was going to be a successful investment for some of those early investors. And so, before that company is public, they're not going to have the ability really to liquidate or get that value from that, get that return from that investment they made. So in many cases, those investors might want to sell once they're able to, which would be when those lockup periods are expiring. Again, what we're talking about here is kind of what the research shows in aggregate. It doesn't mean every single IPO is going to behave this way. There's going to be case by case factors. All of these lockup agreements and everything are very specific to the individual company. And that's why it's important to actually have the flexibility to evaluate these types of considerations on a case by case basis, because they are going to depend on a specific company.
Yeah, I think I remember one of the last big ones was the Facebook, and that was a really big hyped up IPO,
Yeah.
and that came out, and there was all kinds of lawsuits, and the price went down significantly, and then but after time that did really really well. So it didn't get that. Well, I don't remember whether it got that initial pop right away or not, but I know it went down after the public offering and then went up.
That's right. Yeah. And I mean, again, this is what we see by and large. Like, we've done a ton of research on, IPOs. And if you look at them in aggregate, you do see that they tend to underperform other stocks in the market, generally for up to a year after trading. I think a good reason to understand that is likely those expiration of those lockup periods that we were talking about. But that is what you see in the data, right?
Okay, so you can own some shares prior to the IPO, and then when the public offering happens, you own shares. You can buy it on the open market if you're an individual investor and you just want to own some individual shares. But then you can also own it through a diversified portfolio, and you may not even know it.
That's right. All right. Many investors are investing in mutual funds and ETFs. So there's a manager that's actually making the decision about whether or not to buy this new, IPO for the portfolio. And in the case of what a lot of investors will own, maybe index funds. And so in that case, the manager is usually going to make the decision based on what the index provider decided to do. And so we've heard a lot and gotten a lot of headlines lately on index providers, because they've been making a lot of announcements about what they're going to do with this IPO in particular. As we mentioned before, there's been a lot of headlines over this. There's been a lot of interest, a lot of questions about when are indices going to add them. So we can talk a little bit about what some of these indices have said they're going to do. SpaceX obviously recently started trading. In the case of many indices, generally what they do is they're going to add new stocks to their indices on some predetermined time frame. So they might look every single quarter at the stocks that, entered the market over the last, couple months, and then decide to, make them eligible if they meet their eligibility criteria. A couple of things that are kind of unique about this case. The major index providers decided that they wanted to fast track or update that process. So rather than waiting for the normal cycle of when they would kind of evaluate and take a look at new stocks that are eligible, they're going to do it a bit more rapidly, like in the next couple weeks, basically. In the case of some indices, not all. In fact, some other index providers decided they were not going to update or change their eligibility rules. The other thing that comes to play with SpaceX, and I think is really important to remember, is while this company is very large, you've heard headlines about SpaceX's market cap is now greater than, these other big technology names. The amount of shares that it actually offered in its initial public offering was relatively small relative to the size of the company. So even for indices that are making the decision to add this this company to their index, its weight in the index is going to be relatively small, because that weight is based on the shares that are available, the public float, it's called, in the market, not necessarily on the size of the company. If only a small proportion of the company's shares are actually trading, that's the proportion that's going to generally be included in the index. So the weight might be a lot smaller than what some people might expect, just based on some of the headlines around the size of this overall company.
Yeah, that was actually new information to me. I didn't actually realize that. So the indexes, they can't determine how much they're going to buy. They have to do it within their specific guidelines.
Yeah. So, I mean, all these index providers, they have their rule books, they have their guidelines, and those guidelines will say when new stocks are added, and also how they handle questions about how many shares, what's your proportion of shares outstanding that you need in order to enter the index, for example, or other criteria. S&P, for example, is pretty famously known for the fact that they usually report 4 quarters of profitability. That's something that came into play specifically with this with SpaceX, because of course there was a lot of questions around, would they decide not to, adhere to that requirement in the case. And they have so far announced that they were going to keep that requirement in place. So I think what all of these announcements from index providers have shown us is that indexing is something with a lot of decisions. Just because there was a rule book doesn't mean that an index provider can't come along and say, I'm going to change this rule and not this rule. And I'm going to change, this fast track procedure where they're going to change the timeline, for example. I think it shows us that there's a lot of decisions being made by index providers that then have impacts for everyone that's invested in one of the funds that tracks that index. Because generally, the folks that are trying to track that index, they want to minimize the difference between that index. So the index says we're going to buy, SpaceX shares at the close on this date. Well, if you're trying to follow that index, you probably want to make sure that you're following it at the close. And what we've seen a lot, very consistent with a lot of new IPOs, is a lot of volatility in the share price. So everyone's trying to buy the same stock at the same time on the same day. Generally, that's going to have an impact on price.
So let's stick there for a second. I think this is really important for the SpaceX IPO, and I just think for indexes in general. Can you talk about the impact that has on the price that you just mentioned, this idea that you have to buy at a specific time? Because I know
Yeah.
Dimensional does it very differently, and this is a very big reason why you guys do it differently.
Yes, we do. So, an example we often like to use is for anyone who's gone out and tried to buy flowers because they forgot right until Valentine's Day for their significant other. Like, you're paying a bit more at the florist, right? You're paying a premium because you're buying roses the same day as everyone else wants it. Ever tried to get home from New Year's Eve at midnight, just after midnight? The Uber surge pricing is huge because everyone else wants a ride at that time. If you're buying something when demand is high, you're going to likely have to pay more just because everyone wants the same thing. And so, we find the same thing is true. And I think it's one of the pitfalls with, indexing when you see, how rigid index is about how they, buy and sell. Generally, what indices do is they're going to decide to change their index. So, sell and buy securities, change the membership in that index at some predetermined periods of time. That's the way that they try to keep turnover or a lot of trading low, is they don't trade every single day, right? They keep it to a couple days throughout the year. They're going to do the same thing when it comes to these new stocks that are eligible. They're going to pick a time. They're going to say, okay, on this date, we're going to add name XYZ to our index. And for anyone that wants to match the index price, they've really got to trade at that date and time. And so what that means, the same as buying roses on Valentine's Day, is you're going to be buying it when everyone else also is buying. We at Dimensional really try to avoid that. We think that there is tremendous value in having flexibility. So, just when it comes to thinking about how to trade, when to trade, how to use that flexibility, we want to try to avoid trading something at the same time when everyone else wants it, or even having that predetermined time where you think, okay, we need to buy all the shares that we want of this company on this particular day at this particular time. Our whole process is extremely flexible. So we're going to go out into the market and look at what stocks we want to buy based on expected return, other characteristics. We're going to do that throughout the trading day. We're going to do that there are 252 trading days over the course of the year. So if you're only trading on a handful of them, you're really concentrating a lot of your activity into just a few points in time, rather than having the flexibility to trade across the entire year.
So that's probably what keeps the cost of an index very low. There's not a whole lot of work that goes into this. You just set your guidelines and you operate.
Yeah, I mean, as a former portfolio manager at Dimensional, it does sound a little appealing to just get come into work maybe a couple days a year to trade the portfolio. We often think of indexes as low cost, and I think I'd argue they're low expense ratio. That number that you see in the prospectus, the expense ratio, is typically pretty low for indexes, but there can be a lot of costs associated with the rigidity of an index approach, with having to follow these rules, having to, trade at some pre-described times in order to match that index. There can be a lot of costs that are built into that type of approach. that are just a little bit harder to see and maybe don't factor into kind of what you see when you're looking at that expense ratio. So I think it's really important. There's value in flexibility. There's value in being able to be flexible with how and when you trade. And that's a really important part of Dimensional's approach.
That's really interesting. So a lot of investors or retail investors or people we talk to, they're like, oh, I want the index because the cost is really low. It might be 0.03 basis points, but there's additional costs as you're describing. There may be some trading costs and other things that it's harder to see.
That's right. We really encourage investors to kind of look under the hood and try to really understand what costs might be harder to observe, but can be really important and can be even more meaningful. And I think the other thing about indexing too is that, you've seen just in this case of the announcements of the last couple of weeks, indices updating, changing their methodology, their rule decision. Often when we're buying an index fund, we may not put a lot of rigor or thought into what the index fund manager or index provider is actually doing, but they're making a lot of decisions that are going to have an impact for investors. And so I think it's really important that, we're thinking about all those decisions, which are often feel quite active, right? Making these
Yeah.
decisions to say, all right, well, we're going to change our rule set for this company, for example, or we're going to update kind of how we're doing this. Those decisions are happening. And so I think it's pretty important that investors are understanding and really understanding all the implications for that decision making too.
Awesome. So I'm not going to keep you much longer, Althea. Just Dimensional's approach. When are you guys going to add SpaceX
Yeah.
to your portfolios?
So
I know you're not
let's
going to answer that, by the way.
no, but I also understand that you've got to ask. So, Dimensional, again, I mentioned that Dimensional has flexibility, mentioned that Dimensional is going to look at what we care about are thinking about expected return characteristics. And we also think about evaluating these on a case by case basis and really understanding when do these lockup periods expire? What do we understand about what the research tells us about expected returns? We're not going to get swayed by just these headlines that are out there or kind of these decisions of an index provider. For example, we're really going to take our approach that we take across IPO. So while, yes, of course, I cannot comment on what we were doing about this specifically, I can tell you that our approach to new IPOs, which happen all the time, right? This is not a new phenomenon. This is something that is happening all the time in markets. We have our approach that is very much built on applying our flexibility to understand, and evaluate companies as they enter the market. And we're looking at expected return. We're thinking about these things like the lockup period expirations, which we know have a headwind on returns, and making that decision. So, that's our general approach. And, we think that it's one really built in what the research tells us and built in a solid understanding of expected returns, and one that isn't going to get swayed by, kind of the latest headlines or all the, hype that goes alongside with a lot of these big name IPOs.
I've worked with Dimensional for a long time, and if there's one thing I can say, you guys do not get swayed by the hype and the headlines. It's a very disciplined approach, and it's not saying you haven't changed and you haven't incorporated things, you haven't evolved over the years, which is phenomenal. It's just very thoughtful approach to investing and done with research based on what works as opposed to in the moment type of decisions.
Yes,
Just because
that is exactly
that's
right.
what.
And I think we're very proud of that track record and proud of the fact that we work with partners like yourself that understand why behind our approach.
Yeah, and that's ultimately what leads to a successful investment experience in my mind. So, Althea Trevor, thank you so much for taking the time to speak with us today. Really helpful to understand what's going on in the markets and have you guys as a partner and allow us a little bit deeper understanding into this whole SpaceX IPO.
It's really a pleasure to talk with you today.